welcome everyone to this podcast, which is the first of a series that will be held in 2026 and will feature the key players within the funds industry. With me here today, I have Dr. Nicholas Micallef from Ganado Advocates and Alan Borch-Olivier from Zampa Partners. I'm Janice Hisler, also from Zampa Partners, and I'll be your moderator for today's podcast. Nick and Alan, would you like to introduce yourselves?
Thank you for having me, Janice and Alan. So I'm Nicholas Micallef, a senior associate within the investment services and funds team of Ganado Advocates. I've been working in investment services and funds for over 15 years now, mostly with the structuring, licensing, incorporation of different types of collective investment schemes and service providers that provide services to such collective investment schemes.
I'm Alan Borch-Olivier, an audit leader at Zampa Partners. I've been working on the audits of such collective investment schemes for quite a number of years now, around 10 years. I'll be going through the audit considerations with respect to this podcast.
Thank you for the introduction. Nick, to start us off, perhaps you could give our listeners a brief overview of Malta's funds landscape.
Yes, I think over the past 15 years it has developed quite a lot. I think Malta has positioned itself as quite a flexible and pragmatic jurisdiction. We have a very approachable regulator that is very open for discussions, and there is really the full spectrum of collective investment schemes. So for any type of fund that one would like to set up, I think that Malta has the solution, from fully harmonized UCITS funds to the far more, let's say, niche family office type structures. So I think Malta has a solution for everyone. It's just a matter of understanding what the individual or the entity needs and thus catering accordingly.
And you mentioned Malta offering the full spectrum. So when talking about that, we understand that there are a number of different products that Malta offers, from your UCITS fund, which is catered for our retail investors, to the newly introduced NPIF, which has now expanded to accommodate single-family office structures. Alan, from an audit point of view, how would your audit procedures differ depending on the type of license that you're looking at?
As you rightly mentioned, I mean, there are a vast range of licenses that are being offered by the authority. And from an audit point of view, I mean, one of the first things we need to do is understand what type of license the scheme is operating under. Even in terms of understanding the entity ISA 315 revised, we are also required to understand the laws and regulations which sort of govern the scheme, and this is why it's critical, because each license has its own set of rule books which are being issued by the MFSA. We're also, as I said before, we're also required to understand the laws and regulations, and even from a compliance point of view, we need to understand that the fund has to appoint a compliance officer to ensure compliance with these rules. But having said that, as auditors, we are still required to review compliance reports to ensure that should there be any breaches, these are being communicated to the respective parties accordingly. We also need to ensure that the breaches are being disclosed in the director's report from a financial statements point of view, and this is part of our audit opinion at the end of the day. Although we're not giving an opinion on the other information, the director's report, we're still required to ensure that it's consistent with the information that we've come across over the course of the audit.
Yes, in fact, ISA 315, which is the identification and assessment of risk, is so important for all audits, including our fund audits, and that is where we sort of form the basis of the procedures that we want to be carrying out based on that understanding that we have obtained. I'm going to turn to you, Nick, and starting off with our UCITS funds, which are probably the most familiar products. How would you define a UCITS fund for our listeners here today?
So a UCITS fund is a collective investment scheme that is operating under the UCITS directive. It can either be self-managed or managed by a UCITS management company, and it is a fully harmonized product. So a UCITS, in theory, a UCITS which is set up and licensed in Malta will be exactly the same as a UCITS which is set up and licensed in Luxembourg or Italy and so on and so forth. It is the product which is best suited for retail distribution. So not exclusively available only for retail investors, so you can still have investments from professional investors and institutional investors, but it is a product which is simple enough to be understood and to be invested in by retail investors. So here there are restrictions under the UCITS directive on eligible assets. So you have more vanilla and traditional type of investment strategies with investments in transferable securities, like listed equities or bonds, very limited use of derivatives. So there are types of asset classes that retail investors are more familiar with and find it easier to understand. There are also some rules around diversification, around leverage as well, and there is, I would say, the most onerous level of investor protection and transparency, given that they are geared also towards retail investors, where if you have a product which is based for a more professional type of investor, they are assumed to have a certain amount of knowledge. With retail investors, you don't take these assumptions for granted, and you have to cater for maximum amounts of transparency and investor protection.
Yeah, so in fact, when it comes to UCITS funds, we are looking at the highest form of regulation, particularly because we are dealing with retail investors in this case. I'm going to turn to you, Alan, from an audit point of view. What would we be looking out for when auditing a UCITS fund, factoring also what Nick mentioned regarding eligible assets, diversification and leverage?
So if I have to go into all the detail, we'll definitely be here for quite some time, so we'll jump straight into it. Let's start with eligible assets. What do we mean by eligible assets? As Nick rightly mentioned, they're the securities which ultimately are being invested in by the fund, and here we're looking at shares, so equities, bonds, commercial papers, treasuries, which are listed on a stock exchange or regulated by a market. So that's in terms of eligible assets. He also mentioned diversification. What do we mean by diversification? It's basically a limitation, a capping on the investments, the percentage sort of that can be invested by the fund. In fact, the rule books also stipulate a number of limitations. For example, you cannot invest more than 10% in the same investment, and also more than 5%. You cannot invest more than 5% in an investment which is being issued by the same body, the same party. There is also a limitation on the cash. You cannot hold more than 20% of your cash within the same financial institution. So as you can see, there are quite a number of limitations which are sort of being imposed by the rule books.
And all for purposes of protecting the investors.
Exactly.
In this case. Yeah.
Now from an audit point of view, what we need to ensure is that obviously the cappings, the investments are within their cappings and they're not in breach. Now what we need to keep in mind as well is that typically we're looking at year-end positions when we come to testing investments and even cash. So that is why, and I go back to the answer to the first question, the review of the compliance reports and breaches register is key, because should there be any breaches to the limitations, to the cappings, these should be disclosed over there and obviously communicated to the MFSA accordingly. So again, reviewing compliance reports is super important,
Yes.
As well as any other procedures to ensure compliance with the relevant laws and regulations.
And this is something as well that we request at the initial stages of our audit. We make sure that we do have everything in hand so that we can review, and anything with an audit impact we are sort of reviewing and looking into. So we discussed UCITS and the type of investments that they're allowed to make and their investment limitations. Now, as we mentioned before, there are other licenses apart from UCITS. So Nick, I'm going to turn to you. When would a UCITS license not be appropriate?
So a UCITS license would perhaps not be appropriate, first and foremost, when the entity that's going to be managing that fund is not a UCITS management company. So if you are licensed as an alternative investment fund manager, or colloquially referred to as an AIFM, then of course one cannot then manage a UCITS fund. But also when the type of asset classes that you want to invest in, that you want to form part of your portfolio, or the type of investor that you are specifically targeting are not retail investors or traditional type of assets. So let's say, for example, one wants to have a portfolio composed of real estate or private equity or other more niche asset classes like, let's say, diamonds or art or vintage cars. In that scenario, these are not assets which are permitted to be invested in by UCITS funds, and therefore one would need to opt for alternative solutions, the more alternative investment fund type of solutions.
Okay, so in fact we mentioned these alternative investment funds. How would these sort of differ from your UCITS funds, Nick?
So first and foremost, it permits you to have far less frequent liquidity. So by this I mean that when it comes to UCITS funds, these traditionally are daily funds or weekly funds. So funds in which you can have daily or weekly subscriptions and redemptions, which allows it to be more digestible for retail investors as opposed to having to invest and then have a more closed-ended type structure or wait for a year until you're permitted to exit the fund. So first and foremost, alternative investment funds would permit you to have, let's say, lock-up periods if the strategy requires it, or annual dealing days. But also, alternative investment funds allow you to invest in, as I was mentioning, more niche types of asset classes. I mean, we have funds that invest in directly in crypto assets, for example, or invest in vineyards, or invest in private equity, real estate projects. These are all types of funds which are not permitted under the UCITS regime, but they are permitted under AIFMD,
Yes.
so therefore for your alternative investment funds or notified alternative investment funds.
So when we're comparing the two, the main differences lie in the type of investors that the funds are targeting, and also the asset classes that they are permitted to invest in. Adam, from an audit point of view, when you come to audit an AIF, what are you looking for? What are you looking at here?
I mean, as Nick mentioned, the main difference is with the underlying investment. So with the AIF structure, you can have more in liquid assets. Having said that, it doesn't mean that you cannot invest in your liquid assets, same as a UCITS.
Yes.
But there is the option to invest in liquid assets. And obviously from an audit point of view, this means that there's a risk of valuation, which means that, I mean, given that we adopt a risk-based approach and that there is significant judgment and uncertainty regarding the valuation of this investment, then obviously it poses a significant audit risk.
And that is where we're naturally going to be focusing
exactly.
more audit attention.
I mean, given that we adopt a risk-based approach, that is where it's going to be an area of focus and something that we obviously need to address during the course of the audit. Now, the AIFM as well is also required to either appoint a third party to carry out the valuation of this illiquid asset, or else carry out the valuation in-house itself. I mean, from an audit point of view, it doesn't really make a difference who is carrying out the valuation, because in our eyes, in accordance with the auditing standards, both parties would be deemed to be a management expert.
Yeah.
So obviously we need to ensure then that we are obtaining sufficient and appropriate audit evidence to ensure that the valuation of that particular investment of the liquid asset is fairly stated.
Yes. Thank you, Alan. Nick, which investors would an AIF be targeting?
So an AIF, speaking specifically of alternative investment funds here, they are a harmonized product similar to UCITS in that they are a product which exists under an EU regime. And therefore they can be passported throughout the EU just like UCITS to professional clients. However, in Malta, one is also able to have investments from qualifying investors. So under the Maltese Funds Framework for AIFs, one can accept investments from qualifying investors and from professional investors, but in terms of marketing throughout the EU, this will be limited to professional investors.
Okay. And from an audit point of view?
From an audit point of view, what we're looking at here is basically the subscriptions, so the money that is being injected into the fund by the investors. I mean, from an audit point of view, we just need to ensure that the appropriate documentation is being obtained by the administrator to ensure that the fund should have accepted the subscription in the first place.
So we spoke about UCITS and we spoke about AIFs, and then there are also our notified AIFs. Nick, perhaps you could tell us a bit why these are popular?
Yes, in fact, in my spare time, which there isn't much of recently, I tend to check the statistics of the MFSA on a quarterly basis, which they publish, and it's quite clear that there is a trend that notified products seem to be more popular than licensed products, and the reason is that these were developed to address, let's say, a key aspect that is sought after by promoters or investors that want to launch products, which is time to market. So notified alternative investment funds address the element of speed, wherein the preparation of the documentation is the same, because you basically have to draft the offering documents, you have to draft all the, incorporate the entities and so on and so forth, but then instead of submitting an application back to the MFSA to go through a licensing process, you submit documentation to the MFSA as part of a notification, and then the MFSA have 10 working days to include that entity on the list of notified days.
So quite a difference when we're looking at the licensing process for NA.
Correct. So the documentation part is the same, but then the part of with the MFSA, as opposed to being, let's say, a close to 3-month process, would last 10 working days, which obviously is quite a substantial.
Of course, a big difference. Alan, when it comes to an AIF, do you see any differences from an audit point of view?
From an audit point of view, not much when looking at an AIF and an alternative investment fund. However, from an operational point of view, there is one sort of key difference. An AIF must appoint a third-party investment manager, whereas an alternative investor fund can either appoint a third-party investment manager or else sort of carry on the role in-house and will be considered to be a self-managed scheme. So if it's self-managed, obviously from our end, then we need to ensure that we're obtaining the investment committee minutes, because ultimately the role of the investment manager is being replaced by that of an investment committee, to ensure that basically all investment decisions are being made in line with the relevant supporting the offering documentation and the laws and regulations.
In fact, Janice, on this point, the reason why a notified AIF cannot be self-managed is because the MFSA is putting certain onus on the licensed AIFM to take on the, let's say, the due diligence role and the supervisory role over the notified AIF, because it does not obtain a license, so therefore there has to be someone that takes responsibility of ensuring that the directors, the founder shareholders, the service providers are of a certain competence and have the capacity to handle that project. And this role is taken on by the AIFM that takes the responsibility of the structure before submitting the notification back to the MFSA.
And it makes sense.
Thanks.
Yes. Nick, any concluding remarks on why an AIF would be more beneficial apart from the licensing process for a notified AIF?
No, I mean, the main point is that which we've been discussing, which is the time to market. So it allows individuals or entities that have a specific investment strategy which may be time sensitive. I mean, more recently investing in crypto has become very popular over the past 4 or 5 years, and therefore obviously if one wants to take advantage of a particular aspect within the market within let's say a quarter, to obtain a licensed entity may take some time, whereas to launch a notified product may be quite swifter. It's also when you have identified already who your first investors are going to be, securing that subscription as quickly as possible before losing them to other products is key. So therefore the notified AIF allows you to benefit from
so speed is definitely a big advantage over there. So we've looked at UCITS, we've looked at AIFs, and we've looked at our notified AIFs. Now we'll move on to a product that has been possibly around for the longest, the PIF. Would you still consider this to be relevant, Nick, or has it become obsolete due to the other licenses that are being offered?
No, I would tend to think that the decision taken by the MFSA to retain PIFs within our funds framework when transposing AIFMD was a very good decision, and it proved to be a very positive one. We still see new professional investor funds which are set up. And it allows for more flexibility within the local funds framework. So an alternative investment fund, an AIF or a NAIF, may only be managed by AIFMs, whereas professional investor funds allow for, they can either be self-managed, but they can also allow for de minimis AIFMs to manage them. So the PIF is a flagship product of the Maltese funds framework. It's been around for far longer than I have been practicing, and I think it's still sought after, and it is still, let's say, the lightest touch regime in terms of products available on the local market, and therefore I feel, given that you don't have full requirements under IFMD, And there are certain permissions, such as, for example, not requiring a depository to be
Yes.
appointed, which allow you to have maybe a less hefty from an ongoing fees perspective and a more lighter structure for let's say, individuals or entities that want to set up a bit of a lighter regulated structure.
And then when we when we speak about our notified PIFs, how do those improve on the PIF?
So the notified PIF then, let's say, was an experiment to marry the benefits of the PIF, so the flexibility, the lighter structure, the lighter touch regulation, with the, let's say, relative success of the notified DAFE insofar as the notification process is
Yes.
concerned. So you have a PIF regulation, but the process to obtain authorization, or in this case notification, is swifter because you, similar to the notified DAFE, you prepare the pack of documentation and you submit to the MFSA for notification within 10 working days as opposed to a licensing process. Here, of course, you don't have the AFIM to take on the responsibility of vetting the structure, so you have what is called a due diligence service provider that carries out due diligence on the directors, the founder shareholders and all the service providers, taking on that responsibility that is played by the AFIM
Exactly.
under the notified AFE regime.
And in fact, when it comes to MPIFs as well, Nick, one of the most talked about developments recently was the single family office solution. I don't know if you can explain this to our listeners and
Sure.
what exactly what we mean by it.
Yes, so from a single, the family office solution is something which I think as a jurisdiction we've been thinking about and working on for a good couple of years now, but it's came into force properly over the past few months. And basically it permits a family or an individual to invest in a notified PIF structure while also being permitted to have an exempt fund manager being the manager of the structure. The rules around single family offices permits you to, let's say it recognizes the fact that the investment from one family means that there is less systematic risk. You don't have the risk of protecting a variety of different third-party investors.
Because it is family owned.
It's family owned, so therefore the MFSA have recognized this fact and have said, okay, you can have an exempt fund manager, which is basically a normal trading company, which can have a single director, a single shareholder, a single company secretary, and so on and so forth, and it doesn't need to go through a licensing process with the MFSA. And this exempt fund manager manages the notified PIF because basically it is an understanding that the exempt fund manager does not require to go through the licensing process as it is only managing the investments of this one family. There are a couple of
Naturally, the risks are less in this case as well.
Of course, because here we're speaking about no third-party investment.
Exactly.
We're just speaking about one family.
Yes.
There has to be a minimum of 50 million net worth for there to be disqualification, and a minimum investment of 5 million within the NPIF. But subject to certain criteria and conditions, then this is a structure which allows a family to, let's say, internalize different family businesses within an MPIF structure, or real estate investments, or private equity, and to internalize them within an MPIF structure, which can be managed by an exempt fund manager, which allows you for quite some flexibility.
Okay. Alan, from your end, anything to add from an audit point of view on the MPIF?
I mean, the most important thing is understanding the license that is held by the scheme, the service providers involved, and ultimately the underlying investments. I mean, obviously in the case of a family office, as Nick rightly mentioned, maybe private investments are going to be more common.
Yes.
So over there, obviously, there's a risk of valuation, which we need to ensure that risk is being counted.
Yes.
Now, Nick also mentioned two limits in terms of notified PIFs sort of that are being used for the family office structure, and there is an exempt investment manager involved. The 5 million and the 50 million. So the 5 million, we need to ensure that the investors subscribing into the fund invest a minimum of 5 million. So when we're testing our subscriptions, we need to ensure that this threshold is being met. And we must also keep in mind that if there had to be a partial redemption, or it cannot fall below the 5 million.
Below the minimum holding.
Exactly. And then we also need to ensure that obviously the investor subscribing into the fund has a net worth of over 50 million, as otherwise they'd sort of be failing that test, and we need to question whether the subscription should have been accepted in the first place or not by the transfer agent.
Nick, why would you see MPIPs as an area of growth in 2026?
I think all the conferences, networking events that I've been attending these past couple of years, the rise of family offices seems to be quite prevalent. So I think that there's this increased focus on family offices managing the family wealth, and therefore I think it's good that we have a solution which is flexible, has a light touch regulation with the exempt fund manager, and as a jurisdiction which is predominantly English speaking, which is based within the EU, where we have an approachable regulator, marrying also elements of common law with civil law, which is quite unique, where families are now becoming more global and you have individuals that are based in a number of different countries. Therefore, being able to understand succession laws of different jurisdictions, for example, is very helpful. I think all these criteria put together make for a nice cocktail of a good solution, basically, for family offices. So I personally think, and we were already seeing this, we're handling a couple of client processes at the moment, and I think that we're going to see this more and more throughout 2026.
And with that, Nick, what advice would you give to promoters or families considering Malta as a jurisdiction to set up their funds?
I think mainly there's a number of criteria to consider, right? And one must first start off with what type of investors are we going to be targeting?
Yes.
What is the investment strategy? What types of asset classes are we going to be investing in? Who is going to be managing the structure? What sort of liquidity timelines are we speaking about? And then, having analyzed all these things together, we are able to see, crucially, whether or not one wants to collect third-party investments, so if we need to passport throughout the EU. We haven't really touched upon passporting, but basically what we're referring to when we say passporting is that the ability of a fund in Malta, via a simple notification process, to also market the units of that fund throughout the other jurisdictions within the EU. So if you need to do that, then obviously you can't have a PIF or an MPIF type structure, because those are unique to Malta and they are not harmonized under an EU directive. So you would need to go for a UCITS or an AIF structure.
Yes.
So it's basically considering these elements and then making sure, which is something which is crucial at the initial stage to ensure protection for the investors, to align the investment strategy with the liquidity. So if we're speaking about, for example, a real estate project, if the three of us want to put forward a certain amount of money to purchase a plot of land in the north of the country to build a commercial mall, if one of us want to exit within a week or two, it means that you need to sell the land at a loss and so on and so forth. So if you're doing that type of structure, then you would need to say have a lock-in period of 3 years, which allows us to build, and so on and so forth, and then you will. So you would need to have all these things into consideration to align the liquidity of the fund with the investment strategy.
And that makes sense as well. Alan, any concluding remarks from your end when it comes to auditing?
No, I mean, probably it's around the 10th time that I'm mentioning this, but the understanding is key. I mean, ISO 315 revised, following the revision, the main focus was on understanding what the entity is doing. In this case, the type of investments which are being made, obviously from an audit point of view, if a fund is investing in your listed equities, your listed bonds, it's obviously less risky than investing in real estate or diamonds or fine art or whatever, or private investments as well. So obviously over there we then need to tailor our audit approach differently depending on the situation that we have in front of us. But again, understanding the service providers, the type of investors that are being targeted, and the type of license that the scheme has.
I think, Alan, sorry to cut in, I think the importance as well of the kick-off meetings that we carry both internally and externally with clients is so important for us to get that understanding and make sure it is applied in our audits.
And even understanding the flow, the processes that are in place by the service organisations in this case,
Yes.
because your administrator, your investment manager are considered to be a service organisation in terms, again, of auditing standards. So we need to ensure that the processes are in place and that the controls are operating effectively as
But
well.
we like our flow charts.
Exactly. From step one,
Documenting,
like leading
yes.
to what resulted in you wanting to buy
Exactly.
that investment up until
Yes.
the investment has been purchased and ultimately reported in the
Yes.
Also, the
non-ledger.
roles of the service providers may change depending on the type of product. So, a fund administrator pretty much has the same role. What changes may be the frequency at which the NAV is calculated.
Exactly.
And however, the role of a depository or a custodian can change significantly. Of an investment manager can change significantly. You mentioned valuations, if valuation is handled internally or externally. So I've had the, let's call it, pleasure of being involved in a few audit processes as well from the license holder side, collecting the documents and
Yes.
submitting to the auditor. It's quite document intensive in
Yes.
terms of collecting the minutes of all the various
Definitely.
entities, whether it's the investment committee or of the board, and so on and so forth, the board resolutions. From the fund side or the license holder side, you need to make sure that you have all the documentation in place, and then from the audit side, you need to make sure that you go through on a risk-based
Exactly.
approach what is pertinent.
Pretty much. We're going through everything.
We're going through each and every single
Yes. Document minutes.
meeting minutes. I
yes.
mean, but obviously we need to.
But that gives us a lot of insight into what happened within the fund and where we need to be focusing our attention. So that is.
Yes, definitely. No, I mean, compliance and this type of review of the supporting documentation is key. And at times you sort of tend to maybe push it to the back and say maybe it's not that important. The figures are
Yes.
more important,
Yeah.
but. Reviewing the minutes is you're going to understand the whole picture,
Of
not
course.
just the figures.
Yes.
So
That is something that has to be
it's
done.
definitely something that needs to be done, and we need to dedicate quite a significant portion sort of our time on
Yes.
reviewing these documents.
And understanding the investment strategy of the particular fund, the liquidity profile of the fund, to be able to then put into practice what there is in the minutes and what is happening in terms of processes to make sure it makes sense as well.
And in fact, from an audit point of view, it's definitely something as well that we need to do, reading their offering documents, their offering supplements, making sure we understand them, and obviously making sure that they are reflected accordingly in the financial statements.
Exactly. I was
as
going to
well.
jump onto one point. I mean, you mentioned liquidity. I mean, liquidity risk is something that needs to be disclosed in the financial
Yes, exactly.
statements in accordance with IFRS 7. So over there, we definitely need to understand the liquidity sort of the fund, whether there are any restrictions on redemptions,
Yes.
and this type of information to ensure that it's being properly disclosed in
Yes.
the financial statements.
That's it. So I think that brings our podcast to an end. Thank you very much, Nick and Alan, for joining us today. And thank you for our listeners for tuning in. Thank you.
Thank you for having me.
Thank you.